Hello and welcome to this month's Bullish on Business video series. I'm your host and certified master coach, John Randall. It's great to see you. You know, a lot of you have asked about your first meeting with a prospect. Some of you call this a PMM, some people call it an engagement meeting, some people call it just a prospect meeting. Whatever it is that you call it, we can always get better at it. We're going to learn today from one of the very best at client acquisition. D2's very own Drew Watson has year after year after year one of the highest client acquisition numbers. So we're going to learn from him what he's doing in that first meeting. So whatever it is that you're doing, let's look to make a small change. Copy something that Drew's doing. Copy part of his process to improve your process. Let's increase your client acquisition and make this year and next year your best years yet. We also have a timely investment update video and also an outlook as we cross into the new year. And we look forward to seeing a lot of you at our upcoming events. We look forward to our coaching sessions with you. But above all else, let's make next year your best year yet on your path to your 5 and 10-year plans. Everyone stay bullish, and we'll talk to you soon. Take care.
Hello, D2. This Building Your Business webinar is sponsored by A2. When you're looking to buy or sell, contact us. We are the experts in everything with investment banking for your advisory practice. Well, guys, here we are a couple weeks before Christmas. We've had a wild ride this year in the markets, and the headlines are being dominated by what might happen in Congress. Specifically speaking, we've seen in the last couple of weeks the NASDAQ have a sell-off, even though the end of the week was a little bit better last week. And it looks like money is being rotated into more of your, what I would call brick and mortar, traditional names like financials and energy. I don't know if this is a carbon copy of what we had post-election when you had the NASDAQ really sell off and fears that, I don't know what Trump was going to do to him, but a lot of fears there. And then when it looked like we were going to have a stalled agenda in Washington, obviously the NASDAQ really outperformed this year. But then as we get back into it, looks like some tech stuff may work. You've had a little bit of rotation out of tech, some profit taking there, and money go into the two sectors that I mentioned before. Longer term, I think what we need to focus on is one, the client questions we get from clients are, how long can this last? You know, everything seems too good to be true. I think you need to kind of heed those warnings, like the siren song, and basically look at kind of what the fundamentals are. If for some reason a tax deal doesn't get done, that's going to be a real problem, I think, for stocks. I think as we go on through 2018, the most likely scenario is short-term rates continue to move up. I think today is the day of taping, the 3-month treasuries at like 126 on the yield. 10-year right now is at 236. So you've got about 110 basis point spread between that. The spread between the 2-year and 10-year is a little bit more narrow. That's really the canary in the coal mine that we're watching is when those get in alignment or actually go negative. That's going to typically presage most recessions that we have here in the U.S. So I think financials have a really good tailwind because it does look like taxes will get passed. It looks like rates will go up. And bonds this year have not done poorly. I mean they've done okay. And specifically, because the question we get is, well, I thought if rates go up, bonds do badly. I think it all has to do with the delta. How quickly and at what pace are the short-term rates going up? To this point, with no inflation being tracked by the Fed, rates have been able to go up at a pretty measured pace. And that's what the outlook is for 2018. If something happens and they get a hot inflation reading or two and that changes the pace, well, that may be a different story altogether. So that is something we need to watch and be mindful of, and let your clients know that's what you're watching. I think in the meetings it goes better if your clients have a pretty good understanding that you've got your hand on the wheel, you're at the helm of the ship, and that you're paying attention to what's happening. So that's the first thing when it comes to stocks. Let's talk about black swan events. BCA had an article came out last week. The 5 potential black swan events. Basically North Korean instability is number 1 on that chart. If you look at the people closest to the problem, to quote Bob Bonfiglio, let the people closest to the work tell you how to do the work. Well, you look at the people closest to the problem, the South Koreans, I'd say would be pretty close. They're from me to Ben from North Korea. The Chinese, the Japanese. Their markets are all having record years. And truthfully, I think a lot of the instability that we're seeing here in the U.S. basically is U.S. media. The crazy stuff the guy does in Asia specifically really doesn't get that much media attention. I think they figured out that's what he craves, and why give it to him. And the U.S. has just kind of fallen into the lap of keep providing him more and more attention. So that's one potential black swan event. Others would be more upheaval in some of the emerging markets such as Turkey, Brazil. Turkey had a failed coup not that long ago, tried to get Erdogan out of power. Brazil has had sweeping corruption issues, and people have been trying to kind of get assets out of Brazil. So if something happens and you have some type of currency crisis in the emerging market world, that's also a potential event. But they kind of put the chances of that happening pretty narrow. I'd say the most likely black swan event, if you can say that, might be some type of healthcare passage that goes through that has unintended consequences, either negatively or positively, that no one has thought through. It's obvious that the state of healthcare in the United States cannot continue on the parabolic path that it's been on, and changes have to be made. It's kind of like, how do you eat an elephant? Everybody takes a corner and starts chewing. But basically, if healthcare were to go haywire, that could be an event. And the final, probably least likely, would be Bitcoin. I think Bitcoin has all of the symptoms. It looks like a duck, quacks like a duck, walks like a duck, of every historical bubble that's ever been invented, starting with tulip bulbs, going to all kinds of, if you're a finance student, you've had all that on your test, that there's nothing to substantiate the price. It will be interesting now that a market's being created on the CME and the SIBO, and people can really bet against it, what happens. Because it's clear right now it goes up, but getting out of it's not as an easy proposition as you think. So, on your desktop, MarketScope had an article last week that came out about blockchain, which is a different strategy or different conversation than Bitcoin. It was on 12/6, came out at 10:49 a.m. It was deconstructing the hype from the reality with blockchain. So this is available all on your Thompson desktop. You can get that if you have clients ask you about it. But as we kind of get into the year, areas that have done a little bit better than what we've expected, real estate has held up pretty well, and I think it goes back to the rate of change with interest rates. Obviously, healthcare has hit it out of the park. The area that just got pummeled this year was telecom. AT&T and Verizon were in a kind of race to the bottom to offer more and more data services for less money. So, if you kind of are a buy low person, you could look at that for potential, is there value there for your clients? I think, another area that we've seen a very kind of quiet, I don't want to say bull market, but a quiet ascension here has been crude oil. So right now, crude's at $57.69. Most of the year it was in the mid-40s. I think you've got a couple things that makes the background constructive for crude prices going up for most of 2018, maybe into the mid-60s. One is in the U.S., fundamentally, a lot of times when crude comes out, it comes out with gas. And really, the U.S. gas system just has nowhere to put the gas. So that's one thing. And we'll get back to that and why that's important. Secondarily is the situation in Saudi Arabia. If you're not a Sunday morning news show watcher, you may not be aware of what's going on, but basically there's been a slow motion coup, and the younger generation has already come in, taking out the crown prince. I think It's Mohammed bin Salah. They call him MBS for short, like a mortgage-backed security. But basically, he's had most of his potential foes arrested and put up at the Ritz-Carlton Riyadh as a makeshift prison, and it's given oil markets globally a kind of pause. This type of heavy-handed action got the attention of, guess who? The Russians. They came right to the table, negotiated right with him. I think the Russians historically appreciate a ruler that is strong and knows what direction they're going into and takes action. And they've put in a pact, along with risks of OPEC, to cut production. So this political intrigue and potential production cuts, along with continued global demand on the increase, I think has really put a pretty firm footing on the oil markets for now. Now to circle back to the U.S. gas situation. For all of the changes going on from coal-burning plants to gas and gas liquid projects on our coast for export, the real situation is gas infrastructure in the U.S. hasn't been built out like it should have been. And even with Trump coming in, these gas infrastructure projects, as Ben knows very well, are multi-year, if not decades-long projects to connect that. So right now we kind of have a bloat of gas that will slow the frackers down a little bit. So I think that's all constructive on oil prices, and you can kind of see that reflected in prices at the pump. Chevron's definitely outperformed Exxon, but Chevron, BP, Royal Dutch Shell, they've all been integrated, kept their refining business together. They've all had pretty good runs here as we've seen an increase in the energy prices. So check that out, and then I would close with this. Don't turn your back on gold and silver in these areas where everything looks really benign and the market's great. That's where you want to probably consider slowly accumulating the precious metal in case of a rainy day. As I said, the black swan events could potentially happen. They may not. We don't know. But basically, just get some protection for your clients while it's cheap now, and they'll appreciate it more later. Have a great Christmas with your families. And as they say in Owensboro, Feliz Navidad. Today we're going to be discussing how to interpret your value in a prospect meeting. How do you take a new relationship, bring the clients into your office or over WebEx, and show them concisely, efficiently, and transparently how you can make working with you a frictionless experience that provides them great value. I feel like the key to this is a lot of listening and asking questions on the front end of the meeting. Any advisor that has a pretty good tenure of service will also be aware of having the clients bring in their paperwork, areas of their greatest concerns, including taxes, their current investments, if they have a kind of a liquidity event going on in their life, information pertaining to that, and then you can get into interpreting the value for them. Personally, I do use a menu of services, but bring that in at the end of the meeting to discuss pricing. And the first part of the meeting is really uncovering the pain points in their life that they may be aware of, or to put it more bluntly, showing them areas that may be creating the pain, and the pain that they're feeling is just a symptom of that deeper area. Step one, I usually let the clients discuss their overall situation, what their goals are, and what they've been doing. If they have an incumbent advisor, I also ask them how often do they meet, what does that service model look like, because you want to also get a pretty good idea of what's preempted this meeting for them to come in. If they work with Fidelity or T. Rowe or Vanguard Direct, I like to start doing some fishing to find out what has prompted them to come in to get a face-to-face situation. Usually, if they're working with a third-party direct, no-load company, they've gotten to a level of complexity that they're no longer comfortable with dealing with their own finances on their own. If they've been a referral from a very, very good client, they may have a situation that's similar to what your client went through if they work at the same business, and you may be able to help them work through that situation. But let's go through an example if they've been at, say, Vanguard or Fidelity or T. Rowe Price. First and foremost, I work on what they don't. So let's talk about cash flow, taxes, other areas of planning such as estate or insurance. And that really takes up the bulk of the meeting, asking them questions, looking at their tax returns, pay stubs. Is there a more efficient way to build a better mousetrap for them on their financials? And I let the whole first part of the meeting be about that. If you're, go to church, it's kind of the liturgy of the word. That's the first part of the church service. So we go through that, let them kind of discuss what's going on. The sermon in any church service is kind of the pivot point before you get to the Eucharist. So then I'll go into my sermon mode. Interpret the value. This is where we can really interpret the value for the client. Let them know, here's where we can save on taxes. If they are retired, this is pretty easy because what you can look at is where is the tax withholding coming from? Is it the normal IRA gross up, or are they using their Social Security payments more as a more efficient way to handle their tax liability? So we go through that and kind of build the case, so to speak, that when I go into the sermon that we have some ammunition that's not being completed by the incumbent firm, in this case, Vanguard, T. Rowe, or Fidelity. The second part of the meeting then would be, let's look at your investments. Most clients obviously are in your office because they don't feel like they are expert investing people. I think it's also very critical at this juncture to kind of separate the wheat from the chaff, so to speak, and say, okay, is this portfolio for growth or is it a retirement pool for income? Most of your do-it-yourself, or if you're using a no-load company, it's all about growing the assets, and the distribution strategies and how the money's invested is not for distribution. In this part of the meeting, what we look at is how much cash flow is coming from the investments, how much inherent volatility, and this is where you would use a Morningstar report to show how much stock overlap is going on in their portfolio. If they've been doing fine and the market's been going up and it's great, well, chances are right now they're in a growth mode portfolio. So they probably have high concentrations in either Apple, Amazon, Facebook, or all of the above. And you want to look at how much income is coming from the portfolio, because what the critical juncture of this part of the meeting is to let them know how the market's been for the last year and a half isn't necessarily how the market acts for the next 10 years or 20 years of the rest of their investing life, and that's why it's critical to get in with you. So typically I'll build the case of you don't want to be overlapped, you want to work in a transparent environment, and let them know that already they can see that what they're doing, even though they see a statement, really isn't transparent. You can get into looking at fees. Against Vanguard, it's pretty tough because obviously they're pretty cheap. But the crux with Vanguard is to first and foremost let them know they need to be more fully diversified, because when the S&P 500 unwinds, they don't want to be anywhere near it. And the fund offerings on offer for Vanguard, no one's going to call them and say, hey, you need to move from your index fund to this. So that's really the selling point. And you could ask them if that happened in the past in '08, or have they gotten any calls, et cetera. So that's typically how I'll go through and interpret the value broadly when it comes to working kind of a competitive situation is direct with somebody else like Fidelity. Within this, the curveball can be you've got a husband and wife, and maybe the husband or the wife thinks they're the investment expert, and maybe the husband or the wife thinks the so-called investment expert in the household isn't really that. So how I interpret the value is at this point kind of becoming almost like a counselor. How does it make the other party feel? How confident does it make that other person? What's going to happen if the person that handles everything doesn't wake up tomorrow? How's that going to be addressed? There's real value having someone else in your situation understanding what's going on with your life financially, rather than just kind of doing it all over the telephone or online. So that would be another value interpretation piece. After that's been discussed, I do go to kind of the menu of services pitch and say, this is how we work. You want to outline what your fees are. It looks like you want these services and this is what you need. This is the amount of assets. Here's what it's going to cost you in rough ballpark numbers compared to what you've already been paying now. This is when I get into the conversation about the fees and lay out. This is basically what Fidelity or T. Rowe or Vanguard has been charging you, whether or not you know it. It's all kind of baked into the cake. Here's how we operate, and the manner at which we operate is going to be much more transparent than what you're operating under currently. I would go and outline how that works. Where does this come in on your income taxes? Whether or not you want to pay on a flat fee or a CAF. Do you want your SPS fees to come out monthly or quarterly? But basically, at that section of the meeting, that's where that takes place. And then what I want to close with is back to reinterpreting the value. You want to always you don't want to close on, well, here's what it costs you, sign and walk out the door. You want to say, this is what you're going to be getting. We're going to take care of your tax situation. We're going to go back and revisit your ability to retire. We're going to go back and revisit, are you taking too much risk? Do we need to revisit your estate plan? Are you protected against a long-term care stay? So you want to close on the value creation that comes in at the beginning of the meeting. So that's when you're going direct at firm. Your other competitive situation would be if there's another advisor, the incumbent, they're kind of across the table, and whether it be a regional firm like Ed Jones, more of a national wirehouse like Morgan Stanley, UBS, Merrill. You want to kind of have a similar pattern in that let's open the meeting, let the client discuss what their pain points are, and even if they don't really know what their pain points are, you want to bring a few things out. If they brought their taxes in, you can say, well, I've noticed you've got a lot of taxable interest and you're in a high tax bracket. If they paid alternative minimum tax, how did that work? If they say, well, we did planning with our current advisor, what does that look like? I would typically in this situation just back the napkin and say, well, here's how we really get into the weeds on cash flow. Does your current advisor do this? We look at where's your money going to be coming from? How much from Social Security? How much from a pension? How much from your IRA? What should the taxes be withheld on each piece of this along the way in order to make it more efficient? What happens if something happens to one of you? Have you and your incumbent advisor looked at it in this depth? Usually they're going to say no. And typically this value interpretation is you want to kind of use the KISS principle, keep it simple. Don't get too in depth. I usually just draw a small grid with 3 or 4 sources of income, what it all means to them from a tax situation. If the tax return's there in front of you, which it should be, you can show them, even if they're not retired. See down here on the bottom of your front page of your 1040 form, here's where your Social Security amount's going to go in. Here's what that says. If they're getting close to retirement and they work with a current advisor, I'm sure their current advisor has given them some type of guidance on when they should draw Social Security. This is another good point to really demonstrate value by going over, is it smart to start drawing at 62? Should they look at a hybrid strategy? Did the clients have birth dates where they fell into one of the loopholes where they could kind of use the hybrid strategy more? So that area, Social Security and taxes, are a real easy point to gain leverage with your client going against the incumbent advisor. Then we will also begin to look at kind of the investments. Picking these apart will be pretty simple. I mean, typically they're probably getting a wrap fee. They've got some type of mutual funds or ETFs. You can run those through the personalfund.com grid to get an idea of what the total fee experience is for the client. Take that in comparison to the transparent fee experience that we offer and say, here's where you are. You can also look at how overlap they are in one investment or one type of investment compared to others, and let them know this is how much risk you're taking. Let's go back and look at when things didn't do so well in the market. You don't have to say, let's say it's not even a 2008 scenario. Go back and just look at kind of typical pullbacks in the market, how much volatility some of these higher beta names might have to be able to interpret the value for them. Then I fall into, this is what our pricing is, here's how you can pay, and close with the value again. Are you looking at your taxes? Are you looking at your income stream? Are you looking at your estate? Are you looking at how these, what are the opportunities to give some money away, either to charity or to children? So that's what the close is kind of close on an upswing. You need to disclose all the fees and show how you're different, but that's really how we would go in and interpret the value of a client situation. Common objections you might get is one, you have a client that thinks they don't pay anything. So this is where you need to kind of go a little bit deeper into the weeds to basically defeat the absurd. Whether it's Fidelity, Vanguard, T. Rowe Price, Edward Jones, if they really think they haven't paid anything, go right to the prospectuses, the statements of additional information, and show them the pages and pages of fees that are in the millions and millions and tens of millions of dollars. So, I think by that you do a good job there. It's going to be clear that these aren't non-for-profit institutions that are just operating out of the goodness of their heart. They have expenses and payrolls to meet just like any business, and that's one thing that you can show them. If clients think they can really kind of do it themselves, the real value is going to be going over the tax returns, because chances are somewhere along the way they may screw it up. And in a dual client scenario where you have two spouses, chances are maybe the other spouse isn't as confident in the current spouse's ability to handle things as they once were, or maybe they ever were. So that's typically where I'll get the most leverage that I can from that standpoint. But you want to also spend a lot of time on going over what your client service model is. Let them know where they would fit in. Let them know what they can come to expect. And start it off with a follow-up letter. So, what you can come to expect is you get done next week, you're going to get a letter about our meeting. Do you want it by email? Do you want it in regular mail? This just shows how we're different and how we separate ourselves from the competition. So I always end the meeting with the client experience after I've kind of brought them back up on a high point. This is what you're getting. But then we zero in on what the client experience and what it's like to be a client in our practice and what they can come to expect from us. You're setting the bar high, but also what you're doing is really providing that differentiation, and you kind of work to hold you, from where they are, and make sure you get the buy-in at the end of the meeting. Good luck on your prospecting.